Nearly every time there's a war, people panic and sell their stocks. They turn on the news, they get scared, they hit sell. But here's what the smart investors do instead. They're always looking for opportunities. Today, we're going to go back through history to look at what the stock market actually did every time the U.S. went to war. Because if a U.S.-Iran war continues, you don't want to be the one panicking. You want to be the one with a list. If you've turned on the news this week, you know what's happening. Tensions between the United States and Iran have escalated dramatically. There are strikes being reported almost every hour. There is significant military movement. There's fear. And right on cue, your financial news feed is full of predictions about what this means for the stock market. Oil is spiking, defense stocks are up. But before we go any further, today's video is not just about geopolitics. I'm not going to sit here and tell you how this conflict will play out because I have no idea, and neither does anyone else. Right now, while you're watching the headlines and feeling that urge to do something, which is to sell, rotate in and out of something, or maybe even panic, I want to stop you and replace that emotional reaction with a logical framework, because the investors who build real wealth over time, they're not the ones who reacted fastest to the news. They're the ones who didn't react at all. So let's talk about why. So let me start with something fundamental. The stock market, in the short term, is a voting machine. What that means is what's popular will go up, what's not popular will go down. It's constantly taking in information and trying to price in what the future will look like. Guys, I'm going to put this in no uncertain terms. In the short term, it is terrible. Genuinely terrible. It overreacts to bad news. It overreacts to good news. It's driven purely by human emotion. And in moments of crisis, it's literally never calibrated correctly. When scary headlines hit and a potential war between the United States and Iran is as scary as headlines get, the market's first reaction is almost always to sell. Investors are going to dump stocks that they don't want to be holding if things get worse. Oil surges, gold surges, defense names surge, everything else falls. And for the investor watching their portfolio drop in real time, that instinct is powerful. Get out, wait for the dust to settle, get back in when things are clearer. That instinct alone has cost investors more money than almost any other single behavior in the history of the stock market. Because although the market is a voting machine in the short term, it is a weighing machine in the long term. The fundamentals are what's going to drive the value. And I can prove it with over 75 years of data. So let's go to the actual chart. Now, guys, I don't know what's going to happen with this US-Iran war, if it's going to be long, if it's going to be short. In fact, it's funny. I was born in Iraq, and the number of messages I've received from people saying, hey, thinking about your family in Iran, I'm like, yeah, I'm not from there. The war with my country was 20, 30 years ago. But either way, what we're trying to teach here is a behavior. That title we had isn't saying the actual war will create millionaires. What's going to create people to make a lot of money in the future is learning from this war and the behavior you needed to have. That's what this video is about. So I'm going to show you something. This is our S&P 500 chart going back decades to 1950, and it maps a chunk of every crisis, war, even scary headline, right alongside which president was in office and how much the market returned during their tenure. I want you to really look at this because what it shows is more powerful than anything I could just tell you. Look at where this chart starts. Korean War is right here, marked on the chart. Then we see Eisenhower took office. The country was in active military conflict on the Korean Peninsula during the early months of his presidency, and yet, during this time, the S&P returned about 142%. Then we move into JFK, Lyndon B. Johnson. Cuban Missile Crisis is right there. We came close to nuclear war during those 13 days in October of 1962. People were genuinely terrified that civilization was ending. And what did the market do over that presidency? It just kept going up. Johnson's presidency saw a gain of over 40% of the S&P. Look at Vietnam. Look at this chart. The Vietnam War runs right through Kennedy, Johnson, and Nixon presidencies. Nixon resigned in 1974. The market under Nixon posted a decline of 26%. Yes, it was negative, but notice what happened next. Ford comes in, the market recovers up 38%. Carter follows up 28%. The chaos of Vietnam, the resignation of a president, Watergate, and the market just keeps climbing over time. Now, let's look at the Reagan years. Stagflation coming out of the 70s. That meant stagnant growth with lots of inflation. 18% mortgage rates. We complain about 6% now. They had 18% mortgage rates back then. Black Monday, 1987, the market fell 22% that day. People thought the financial system was breaking. Reagan's presidency, it finished up 109%, more than doubled, through stagflation, through Black Monday, through the tail end of the Cold War. Now you have George Herbert Walker Bush. Gulf War is right there. Now this is the war involving my country that I was born in. Iraq invades Kuwait. Operation Desert Storm hits. In fact, our CEO, Tim, his father fought this war. He might have actually killed some of my family members. We're still trying to decide if that actually happened or not. That was a joke. I know people say that's a sensitive joke. I'm sure Tim's father didn't kill anybody, definitely not any of my family members. Oil prices spiked, market sells off, and his presidency still returned 57%. Guys, during the Clinton years, 208% growth, absolute insanity. And notice what's on that chart during Clinton's presidency, the savings and loan crisis. And then right there at the end, the dot-com bubble beginning to really inflate. The bubble peaked in March of 2000, right before the election of 2000. Then Bush, the dot-com bubble, the continued burst happens. We had 9/11, guys. September 11th, the worst ever terrorist attack on the U.S. You can see it marked right there. The market closes for 4 days, reopens, drops 14% in a week. Then, Iraq War number 2. The housing crisis begins building. Bush's presidency finishes down 37% as he ends during the financial crisis. That's a rough stretch. If you look back at all of these results, you look back at where valuations were when these presidents started to take over, and that's what you see in common. When there were high valuations, performance was bad. When there were good valuations, low valuations, performance was good. But here's another thing I need to tell you. Look at what Obama inherits. Housing crisis fully detonates, financial system nearly collapses in 2008, and from that rubble, during Obama's 8-year presidency, the S&P 500 returned 167%. From the ashes of the worst financial crisis since the Great Depression. Now Trump, good old Trump, up 68% in just 4 years during Trump number 1. Brexit is on this chart. COVID is on this chart. A global pandemic that shut down the entire world economy, and the market still finishes that presidency positive. In fact, in 2020, the market finished up even after having the COVID crash of nearly 40% in 1 month from the middle of February to the middle of March. Biden, up 43% during his term. And now here we are. Do you see what this chart is showing you? Every single presidency, every crisis, every war, every crash, every scandal, every pandemic, they all are just blips on a chart that is relentlessly, stubbornly progressing over time. These events feel enormous when you're living through them. On the chart, they're footnotes. Morgan Housel, author of one of the best financial books of all time, The Psychology of Money, who we interviewed on this very channel, has a great quote. Every past bear market looks like an opportunity. Every future one looks like a risk. Guys, we're here to reframe that for you. We want you to view every future bear market and crash as the opportunity that they are, as the opportunity that they look like after the fact. Now, I want to explain why this pattern exists because I don't want you to just accept it as a historical curiosity. I want you to understand it deeply enough that you believe it, even when the headlines are terrifying. And guys, I always tell people I'm impatient about everything in the world except for 2 things. 1, people I love and care about, and 2, investing. With investing, it's unbelievable that I look at it going like, man, you just gotta be patient. The stock market is not what you see on the news. This is a point I come back to constantly, and it is never more relevant than in a moment like this. The stock market is a collection of businesses, real businesses with real employees, real customers, real products, real revenue, real profit. When the United States goes to war, those businesses do not stop operating. In many cases, they can accelerate. Defense contractors produce more, energy companies see prices rise, logistics companies move more equipment. The broader economy adapts. More fundamentally, the American economy is the most resilient economic system ever built. It has survived multiple wars, world wars, a Great Depression, countless recessions, terrorist attacks, the greatest financial crisis in history, pandemics, and every geopolitical shock you could possibly imagine. And through all of it, the long-term trend has been up. Not just because America has made the right decisions, not because every conflict ended clearly, but because the underlying engine of innovation, productivity, and ingenuity that drives the economy does not stop running because of geopolitical events. Here's the other side of a phrase I mentioned earlier. In the long run, the stock market is a weighing machine. Your long-term results over decades are going to be based on the earnings growth of the very businesses that you buy. Now, it also assumes, like I said before, that you pay a reasonable price along the way. If you pay 10 times what you should for any investment, it is going to be hard to get a really good return on that unless the investment outperforms everybody's possible thoughts and prayers. Now, the second reason the market comes back is even simpler: time. The investors who got hurt in every one of those historical examples I just walked through were not the ones who held. They're the ones who sold at the bottom or near the bottom of the fear and didn't get back in until the recovery was well on its way. They locked in their loss. They missed the bounce, and they told themselves they were being smart and cautious the whole time. And this is what I mean when I say the news is almost never your friend as an investor. The news cycle is designed to maximize your attention, and fear is the most powerful attention-grabbing tool that exists. A headline that says markets volatile amid Iran tensions gets more clicks than markets flat, long-term investors unaffected. Which one would you click on? Guys, I know what they're trying to do, and I would never click on markets flat, long-term investors unaffected. But the second headline is always the more accurate description of what matters. Guys, I always thought to myself recently, like, what's a good analogy? I'm like, I really wish I could buy a portfolio of stocks, be like Tom Hanks in Castaway, be on an island for 4, 5, 6 years, come back, and then see where my stocks are at. Guys, this is kind of like the idea of Warren Buffett saying, if you're not willing to own a company for 10 years, don't own it for even 10 minutes. Okay, so now we've established that wars do create fear, headlines create fear, and fear creates short-term volatility. And that short-term volatility has historically been completely irrelevant to the long-term investor. So now let's talk about what you should actually be doing, because don't panic is not a complete strategy. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope it doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. So guys, the first thing I want to address is the current market environment independent of Iran. And this is a critical context that I think a lot of people are missing right now. And in fact, they probably miss it all the time. Before this conflict escalated, the market was already massively overvalued. If you've watched any of our videos, we talk about this. We talk about this in both channels, and the S&P 500 has been trading at massively elevated multiples for a while. The PE ratio across the market has been stretched. The margin of safety for new buyers is razor thin. There's a metric that I love called the stock market GDP indicator. A lot of people call it the Warren Buffett indicator. Warren Buffett uses it because it says this is one of the most reliable metrics at any given moment. It compares the stock market's value versus GDP, and it makes sense. The larger GDP is, the larger the stock market should be, and vice versa. Now, we're currently sitting at over 120% overvalued. If you look at history, when you're at 50% overvalued or more, your next 10-year return average is negative, not including dividends. Guys, that's at 50% or more. We're at 125% or so. This matters because it changes the math on how you should be thinking about a potential pullback. If the Iran situation causes the market to sell off, whether it's 5, 10% or more, you need to ask yourself, does that sell-off actually bring stocks to fair value? Does it make them cheaper? Yes. Does it make them cheap? No. That is a very different situation. When people talk about things being cheaper, they automatically assume that means they're cheap. They are not. A drop from overvalued to fairly valued or below, that's an opportunity. A drop from overvalued to slightly less overvalued, that's not really the buying opportunity of a lifetime like people have been saying lately. Guys, if you own a house and it's worth $500,000, let's say it's worth $500,000, put it on the market tomorrow for $5 million. What's going to happen? Nobody's going to buy it. Drop it to 3 million. Hey, 40% discount. This thing is a screaming deal. No, it's not. It's still 3 million on a $500,000 value. That's the way I want you thinking. So here is my personal advice for right now. If you're investing in broad market ETFs like an S&P 500 index or a total market fund, keep dollar cost averaging. Don't stop. Don't try to time the market. Don't wait for things to settle down before you put money in, because by the time things settle down, the market will have already recovered. Consistent, disciplined contributions into a diversified ETF over a long time horizon is one of the most valuable and reliable wealth building strategies that exists. Don't let a geopolitical headline interrupt that process. If you're investing in individual stocks, this is where the current environment demands real discipline. I encourage you to be cautious and buy when a stock is trading well below your estimate of its value, what we call intrinsic value. That gives you that ample margin of safety. You need that genuine margin of safety. And right now, with the broad market so overvalued, the list of companies that are selling for a massive margin of safety is shorter than it would normally be. Yes, there are pockets of opportunity. We've covered some of them on this channel recently, and especially with members of our community. But you should not be using an Iran headline as the reason to go buy a stock. The question is never, should I buy this company or this stock because the market is down? The question is this specific business trading below what I actually think it's worth based on its long-term value? And here is the forward-looking point I really want you to hold on to. The pendulum will swing. Markets will go from overvalued to undervalued and back again. We are currently, and have been for a while, on the overvalued side of that pendulum, which means that at some point, whether it's driven by a conflict like this one, a recession, a rate shock, whatever it is, probably something that nobody sees, the market is going to swing back toward undervalued. And when it does, the investors are prepared, who've done their homework, who know exactly what prices they want to pay for the businesses they've been watching. Those investors are going to have an extraordinary opportunity. The investors who panicked at the wrong time or chased headlines into the wrong stocks will not be in a position to take advantage of it. Guys, preparation is not exciting. I get that. Discipline is not exciting. Sitting on your hands when the news is screaming at you to do something, that is so incredibly difficult. But that's why very few investors are able to do it. And this is what separates a real investor who builds generational wealth from the ones who are perpetually reacting and perpetually disappointed. I want to close the analytical part of this video with a simple contrast because I think it crystallizes everything we've talked about today. The emotional investor hears about US-Iran tensions and immediately starts moving money. They sell stocks that feel risky. They buy oil ETFs because oil is going up. They buy defense stocks because defense is going up. They feel like they're being proactive, like they're protecting themselves, like they're one step ahead of the crowd. They are not. They are the crowd. And by the time they've made those moves, the professionals who do this for a living have already priced in those trades. The emotional investor is always the last to buy and the last to sell, and they pay for it every single time. The logical investor hears about US-Iran tensions and asks one question: does this change the intrinsic value of the business I own? And by that, is 20 or 30 years from now, the value of the business I'm buying affected by this war? Not the stock price, the actual value of the business. Does this Iran conflict actually change how many iPhones or iPads Apple will sell over the next 20 or 30 years? Probably not. Does it change whether Visa processes transactions in the long run? Probably not. Does it change whether the best businesses in America continue to generate free cash flow and compound earnings over time in the long run? In most cases, the answer is either no or not as much as people think. And so the logical investor will sit on their hands and do nothing. Or they do more homework. They look at whether the sell-off has created any new opportunities in other markets, any stocks that have dropped below their estimate of fair value. And yes, if that happens, they buy. Not because of Iran, because of value, because of price versus value. You just need a calm, grounded, logical framework that doesn't get hijacked by whatever is on the front page each morning. For us at Everything Money, for our community, we call this principle-driven investing. It is our daily reminder of the core tenets that each of our processes are built upon. I have these posted in my office to read every single day, so let me explain them to you. First off, we are investors, not speculators. Second, every investment is the present value of all the future cash flow it's going to give. Third, if we don't understand it, we don't buy it. Fourth, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the fifth and most important one, a great story becomes a bad investment if you pay the wrong price. So guys, If you're interested in getting those 5 tenets sent to you so you can have it readily accessible for you with explanations for them, I have an absolutely free PDF for you. Click the link below. You will get the PDF sent to you immediately so you can have it readily available to calm yourself down when the noise is out there very loud. Now listen, I made this video because I knew that right now, while this story is unfolding, there are hundreds of thousands of investors making emotional decisions that they'll probably regret. And if I can intercept even a fraction of them, if I can get you to take a pause, take a breath, and think logically before you do anything, then this video has done its job. The history is clear. Wars are scary. Markets drop. Markets recover. The investors who held through World War II, through Vietnam, through the Gulf War, through 9/11, through Iraq and Afghanistan, they came out massively ahead every single time. There's no reason to believe that this time is different. There never is. So keep dollar cost averaging into your ETFs. Only buy individual stocks that are selling well below your intrinsic value. Stay patient as the pendulum swings and be prepared for when the market does crash. Because guess what? Even if you buy individual stocks, they're probably going to go down when or if the market crashes, because it will be the opportunity of a lifetime at some point in the future. You will hear me saying and cheering every single day. Guys, I have a new video that I recorded that demonstrates how a simple, consistent process you can learn will start you on the path to building wealth in 2026 and, more importantly, beyond. So click the video on your screen right now. Thank you for your time.